Right now today, there are roughly 575 million ounces of silver promised on paper inside the COMEX system. The actual physical silver sitting in the registered vaults that are supposed to back those promises, about 77 million ounces. Do that math. For every ounce of real silver that's actually deliverable, there are about 7 paper claims sitting on top of it. 7 different institutions, 7 different traders, 7 different countries, all holding contracts that say they own silver. Only one of them can actually get the metal if everyone shows up at once. Coverage ratio, 14.6%. Below the 15% stress threshold for 6 consecutive months. This Thursday, April 30th, that math gets tested. Thursday is first notice day for the May 2026 silver contract. The day every contract holder has to declare whether they want physical delivery, whether they want to roll forward, or whether they want to close out. As of Friday's close, 17,184 May contracts were still open. That's 89.9 million ounces of potential delivery demand, sitting against 77 to 80 million ounces of registered silver. If even a small portion of those holders demand the metal, this gets uncomfortable fast. Today is Sunday, April the 27th, 2026. Silver is trading at $75.67. Gold sits near $4,800. The Strait of Hormuz is closed. Trump canceled Iran peace talks yesterday. Brent crude is above $105. The Fed meets Tuesday and Wednesday. And Thursday morning, 3 things land at the same time. First notice day for May silver, the Q1 GDP advance estimate, and weekly jobless claims, all before 9 a.m. Eastern. In the next 25 minutes, I'm going to walk you through exactly what a true COMEX delivery crisis would actually look like, day by day, signal by signal, not as a prediction, as a scenario. Because understanding the mechanics is the difference between being prepared and being blindsided. This is not financial advice. Silver is volatile. It just dropped 38% from $121 to $75 in 90 days. Past performance is not indicative of future returns. Talk to a qualified advisor. Do your own research. Let's go. Quick foundation, because you can't understand the scenario without understanding the system. COMEX is the commodity exchange in New York. It's where the official price of silver gets set for the entire world. Every day, banks, hedge funds, and traders buy and sell silver futures contracts. Each contract represents 5,000 ounces of silver. The system is designed to work like this. You buy a contract. If you want the actual metal, you submit a delivery notice during the contract's delivery month. The exchange delivers physical silver to you from approved warehouse vaults. That's the promise. That's the foundation everything else is built on. For most of the system's history, almost nobody actually took delivery. Historically, 97 to 99% of contracts either rolled forward to a later month or settled in cash. The metal wasn't really the point. The contracts were used for hedging and speculation. Real silver in the vaults was almost a formality. That assumption only works as long as nobody actually demands the metal at scale. In January 2026, something broke. In a single week, in early January, 33.45 million ounces of silver were physically withdrawn from COMEX registered inventory. That was roughly 26% of the entire deliverable pool, gone in 7 days. The delivery rate spiked from the historical 1 to 3% toward 5 to 10%. Silver hit an all-time high of 121.64 on January 29th. The CME group, which operates COMEX, did what exchanges always do when a market starts breaking against the shorts. They raised margin requirements, forced leverage longs to liquidate. The cascade pushed silver from $121 down to $60 in a matter of weeks. Now we're consolidating around $75. The pool that got drained in January has not been refilled. Going into Thursday's first notice day, the registered inventory is smaller than it was when January's squeeze started. That's the setup. A real default doesn't happen with a press conference. There's no announcement. The mainstream financial media isn't going to break the story. By the time CNBC catches up, the window for ordinary investors to act has already closed. The signals show up in places most people aren't watching. Signal 1, silver lease rates spike. A lease rate is what you pay to borrow physical silver for short periods. In a normal market, lease rates run a fraction of 1%, almost nothing. Earlier this year, during the January squeeze, lease rates spiked to levels that traders described as multiple multiples above normal. That's not a market functioning under normal conditions. That's a market screaming that someone is desperately trying to borrow physical metal and can't find it. Most retail investors have no idea what a silver lease rate even is, which is exactly why almost nobody saw the January signal coming until prices were already exploding. Signal 2, the Shanghai premium. For most of 2026, physical silver in Shanghai has been trading at premiums of 10 to 15% above the Western paper price. At various points, the gap has been more than $8 an ounce. At its widest, $15. Think about what that means. The exact same metal, 1 ounce of silver, priced at completely different levels in different parts of the world simultaneously. That doesn't happen in a healthy global market. That happens when the Eastern physical market is telling you something completely different from what the Western paper market is showing. What Shanghai is saying very clearly is this: real physical silver is worth more than what your trading screen shows you. Much more. Signal 3. Delivery behavior on first notice day. In recent months, something unusual has been happening. The percentage of contracts demanding actual physical delivery has climbed. Institutional players who used to roll forward routinely are now standing for delivery. They want the metal. They don't want the cash. The February delivery month saw 25.18 million ounces delivered, highest February in modern COMEX history. March delivered another 52.63 million ounces. The 2-month delivery rate that started 2026 was the highest 2-month rate ever recorded on COMEX. That's institutional money quietly losing confidence in the paper system and wanting the real thing before it's too late to get it. If you're seeing all three signals at once, lease rate spikes, Shanghai premium widening, delivery rates climbing, you're not watching a normal market correction. You're watching the early stages of a system under structural stress. We've been seeing all three for months. Now let me walk you through what a hypothetical day one of a true delivery crisis would actually look like. This is a scenario, not a prediction, but the mechanics are real and they're worth understanding. Day 1 starts like any other Wednesday. Markets open, silver is trading in its usual range. By mid-morning, a handful of very large delivery notices come in. Sovereign wealth funds, foreign central banks, major institutional holders. They want physical silver, not cash, not a rolled contract, the metal. The exchange processes the requests and realizes for the first time publicly that they cannot fully satisfy them. They can cover most. The gap is a few million ounces. There's no announcement. The exchange tries to handle it quietly. They reach out to large eligible silver holders, the ones whose private metal sits in COMEX-approved warehouses but isn't currently registered for delivery. They offer cash premiums to convert eligible silver to registered. Some accept. The gap shrinks, but it doesn't close completely. The people involved in those back-channel conversations start making phone calls of their own. By afternoon, professional trading desks in New York, London, and Chicago are picking up whispers. Bloomberg terminal chats light up. Someone with access to internal delivery data leaks a screenshot. Within 24 hours, it's impossible to contain. The retail public sees nothing on day 1. The price on their screens looks almost normal. Silver might be down $1 or $2, which seems unremarkable, given how volatile it's been all year. Most retail investors go to bed that night with no idea the ground just shifted. Day 2. Cracks start showing in places observant people can see. Physical silver dealers report unusual call volume. The spread between paper silver and physical silver widens faster than normal price movements would explain. A coin dealer in Texas tells customers there's a 3-week wait on new inventory. A bullion wholesaler in New York raises premiums. Online silver retailers show certain products as out of stock. These don't look like panic signals to people not paying attention. They look like normal inventory fluctuations. To someone watching the right indicators, they're a clear message that physical supply is tightening beyond what normal demand would explain. On day 2, the paper price often does something that confuses retail investors. It drops, sometimes significantly. This feels backwards. How can silver be getting cheaper exactly when physical silver is getting scarcer? The answer: paper and physical are two separate markets. Entities that hold large short positions in the paper market use moments like this to push the price down further, create the appearance of weakness, shake out nervous holders. They've done it before. The CME margin hike that took silver from $121 to $60 in early 2026 was this exact playbook. The pattern works until it stops working. And on day 2 of a real delivery crisis, we're approaching the moment when it stops. Day 3. The news is out. You can't keep something this size contained. Reuters runs a headline about delivery irregularities at COMEX. Bloomberg follows with a more detailed piece, citing anonymous sources inside the exchange. Financial Twitter explodes. The YouTube finance community, channels that have been warning about this for months, says, "I told you so," in real time. Every retail investor who dismissed the warnings as paranoid is now pulling up those videos and feeling the sinking feeling that comes with realizing you had the information and didn't act on it. The mainstream financial media is still trying to downplay things. CNBC anchors are using phrases like short-term liquidity event and the system has safeguards. They're technically correct that the system has safeguards. But those safeguards are mostly designed to protect the exchange and its large institutional members, not retail investors. The most important safeguard is buried in the fine print. COMEX contracts allow for cash settlement as a final option. If the exchange cannot deliver your physical silver, they can legally pay you in dollars instead. The dollar amount is calculated using the paper price. The paper price that, in this scenario, is being held artificially low precisely because the physical metal isn't there. You can guess how that works out for the person who thought they owned silver. Day 4 and 5 reshape the price landscape entirely. Physical dealers who still have inventory start openly quoting prices that are $30, $40, sometimes $50 above the official COMEX spot price. And customers are paying it, because what's the alternative? Wait for the paper price to magically reconnect with physical reality? Industrial users, the manufacturers building solar panels, electronics companies, medical device producers, EV battery makers are not debating whether to pay a premium. They need the metal to keep their operations running. They will pay whatever physical demand requires. This industrial demand layer on top of investment demand creates a floor under physical silver prices that has nothing to do with what COMEX paper says. Two markets are now operating simultaneously for the same metal at radically different prices. By the end of week 1, the Federal Reserve has issued a statement, carefully worded, reassuring. They talk about monitoring the situation and working with market participants to ensure orderly functioning. The Treasury Secretary appears on a financial news program and says the fundamentals of the American financial system are sound. These are exactly the words used before every major financial event in modern history. The market stabilizes briefly on the reassurance, paper silver bounces. Commentators on CNBC call it a relief rally. They say the worst is over. Then day 8 arrives. New delivery notices come in for the next contract cycle. The same problem is still there, because reassuring words from Washington don't create physical silver in a vault that doesn't have any. Week 2, the global dimension. Foreign governments that have been quietly accumulating physical metals for years are watching this. China, Russia, India, Saudi Arabia, several others. They're not selling. They're holding every ounce because in a world where the largest commodity exchange on earth cannot deliver, physical metal stops being just a financial asset. It becomes a geopolitical asset, leverage, the thing that matters when paper promises from Western institutions start looking questionable. China specifically has been positioning for this scenario. The Shanghai Gold Exchange and Shanghai Futures Exchange have been building their own physical delivery infrastructure, their own pricing mechanisms, their own vaulting systems, specifically so that when the Western paper system runs into the wall it's been heading toward, China has an alternative system already operational. In week 2 of a real crisis, that alternative becomes the reference price for a meaningful portion of global silver trade. The world doesn't flip overnight, but the direction becomes unmistakable. Now let me bring this back to reality, because Thursday isn't day 1 of a default. It's a regular first notice day with elevated tension. What's actually expected to happen? Thursday, most of the 17,984 open May contracts will roll forward or close out before the deadline. That's normal. Historically, 97 to 99% of contracts get rolled or closed. Even in the elevated environment we've been in, only 5 to 10% of contracts have been demanding physical delivery in recent months. So what should you actually watch Thursday? Watch the coverage ratio after delivery notices land? The delivery headline on Thursday will probably be small. Most contracts roll. The headline number will look unremarkable. Coverage ratio will probably tell a different story. If the registered pool shrinks meaningfully despite a quiet delivery day, that means even a small percentage of standing for delivery is taking out chunks of the deliverable pool that aren't being refilled. If coverage ratio drops below 13% on Friday, that's a warning. Below 12%, that's escalation. Watch what happens in the first hour after the GDP and jobless claims data. The Bureau of Economic Analysis publishes the Q1 GDP advance estimate at 8:30 a.m. Eastern Thursday. The Atlanta Fed's GDP Now model has Q1 growth tracking at just 1.2% annualized. The IMF cut its full-year U.S. forecast to 1.8% in April. Q4 2025 came in at just 0.5% on final revision. If Q1 prints weak, that reinforces stagflation fears. Historically, one of the strongest environments for physical precious metals. If it prints stronger, that clears the path for Fed rate cuts later in 2026, which also tends to support silver and gold. Either way, the macro setup leans bullish for silver. The risk is a hot inflation print combined with a strong GDP read that makes the Fed look hawkish enough to crush precious metals short term. Watch silver's price action between 8:30 and 10:30 a.m. Eastern Thursday. That's the window when first notice day delivery activity, GDP data, jobless claims, and the morning after the Fed press conference all collide. The first hour will be erratic. The second hour starts having actual signal. Above $80 with momentum, the structural story is reasserting. Below $74 with conviction, the bears are back in control short term. Let me speak directly to you for a moment, because some of you watching this aren't professional traders or hedge fund managers. You're regular people trying to figure out how to protect what you've built. If you're holding physical silver right now, actual bars and coins in your possession, or in a reputable allocated private vault, you're in a fundamentally different position than someone holding a silver ETF or a COMEX paper contract. Your silver cannot be hypothecated. It cannot be lent out. It cannot be cash settled against your will. In a real delivery crisis, that distinction is the entire game. If you're holding SLV or another silver ETF, read the prospectus carefully. Most silver ETFs allow the fund to hold a mix of allocated and unallocated silver. Unallocated silver is essentially a paper claim, not specific bars sitting in specific vaults with your name on them. In an extreme shortage scenario, the distinction between allocated and unallocated becomes critical. Know what you actually own. If you own COMEX futures contracts and you're counting on taking physical delivery, understand that in a default scenario, your legal right to delivery may end up being converted to cash settlement at a price that doesn't reflect what physical silver is actually trading for in the real world. The contract gives the exchange that option. Most retail futures buyers don't realize this until it matters. A note on silver mining stocks. You might think if silver explodes, mining stocks must be the best play. There's logic there. A silver miner producing at $20 per ounce that's selling for $150 per ounce is printing money. But mining stocks have complications. Physical silver doesn't. Corporate risk, management decisions, geopolitical risk in operating jurisdictions, energy costs, permitting issues. They trade on stock exchanges that can be halted, that have circuit breakers, that can be manipulated by short sellers. In a default crisis, stock markets can behave irrationally. Physical silver doesn't depend on a board of directors making good decisions, or a Latin American government deciding not to nationalize. Both have a role, but understand the difference. The broader economic picture during a real silver crisis is also worth understanding. Silver doesn't exist in isolation. When confidence in a major financial institution breaks down, that loss of confidence ripples through other markets. The dollar weakens because the dollar's credibility is partly built on the credibility of American financial markets. Treasury bonds weaken for similar reasons. Gold accelerates because everything that applies to silver as a store of value applies to gold even more so. This week is genuinely loaded. Let me walk you through it. Tuesday and Wednesday, April 28th and 29. FOMC meeting. Powell's last meeting as Fed chair. CME FedWatch shows 99% probability of no change at 3.50 to 3.75%. The decision is priced in, the language is not. If Powell distinguishes between energy-driven inflation and demand-driven inflation in his Wednesday 2:30 p.m. press conference, that's dovish for silver. If he uses data-dependent in a forward-looking context about easing, that's a soft green light. If he explicitly pushes back against rate cut expectations, that's hawkish and pressures silver short-term. Bank of America's economists have been arguing markets are underpricing how dovish Powell could turn at his exit meeting. Morgan Stanley expects the Fed to cut as soon as Kevin Warsh takes over. Wednesday afternoon, mega cap earnings. Microsoft, Alphabet, Meta, and Amazon all report Q1 earnings the same day Powell speaks. Markets will be digesting Fed language and $4 trillion tech reports simultaneously. Volatility across all asset classes, including silver, will be high. Thursday, April 30th, the triple event. 8:30 a.m. Eastern, GDP advance estimate. 8:30 a.m. Eastern, weekly jobless claims. 8:30 a.m. Eastern, employment cost index. Same morning. First notice day for May silver. After hours, Apple earnings. This is a single morning that could move silver more than any week in months. Geopolitical wildcards, Iran and the Strait of Hormuz. Trump canceled Iran peace talks Saturday. Iranian Foreign Minister Araghchi flew to Moscow to meet Putin Monday. The Strait of Hormuz remains essentially closed. Brent crude is above $105. Pentagon estimates 6 months to clear Iranian sea mines from the strait. Lindsey Graham just publicly called for U.S. military engagement in the strait. Any further escalation amplifies the safe haven case for silver. Any genuine de-escalation weakens it short term but doesn't change the structural picture. I won't close without naming the risks. Anyone giving you only the bull case is selling you something. Risk 1. Thursday's first notice day passes quietly, most likely outcome statistically. Most contracts roll, coverage ratio holds. Silver consolidates between $72 and $82 for weeks. Frustrating to hold through, doesn't change the structural story, but it doesn't reward urgency either. Risk 2, hard landing. If the Fed's continued rate hold tips the global economy into recession, industrial silver demand falls faster than investment demand rises. About 60% of total silver demand is industrial. Silver could revisit $60 to $65 before monetary easing stabilizes things. Risk 3. China import surge was partly timing. April 1st solar tax rebate deadline pulled industrial demand forward. April and May import numbers will likely come down sharply. Headlines will say, Chinese silver demand collapses. It's actually just timing reversal, but it'll feel bearish. Risk 4. Narrative reversal. If crypto, AI stocks, or another asset class absorbs the capital that would otherwise flow to silver, the investment thesis gets delayed, possibly by years. Hold these risks alongside the structural case. That's what real analysis looks like. Here's where we are. COMEX has 77 to 80 million ounces of registered silver against approximately 575 million ounces of total open interest. Coverage ratio at 13 to 14%, below stress threshold for 6 straight months. May contracted has 89.9 million ounces of potential delivery demand. First notice day is in 4 days. The world has run a structural silver supply deficit for 5 consecutive years, totaling 762 million ounces of cumulative drawdown. The Silver Institute projects another 46.3 million ounce deficit for 2026, 6th straight year. No major new mine supply coming before 2033. Iran peace talks just collapsed. Strait of Hormuz closed. Brent above $105. FOMC Tuesday and Wednesday. GDP, jobless claims, ECI, and first notice day all hit Thursday morning. Silver sits at $75.67. Gold at $4,800. Bank of America's bull case is up to $309. Citigroup target $150 to $170. Reuters consensus revised to nearly $80 average for 2026. The loudest narrative right now is that silver had its move and the story is over. The data doesn't support that narrative. The data suggests we're in a consolidation that frustrates impatient holders and rewards people who understand what's actually building underneath. I want to hear from you. What are you watching first thing Thursday morning when first notice day, GDP, and jobless claims all hit at once? Drop your prediction for May silver delivery in the comments. And what's your year-end silver target? I read every comment, and the discussion in the comments is genuinely the best part of running this channel. If this breakdown helped you understand the COMEX squeeze setup that almost nobody on financial media is talking about, hit subscribe. Share it with one person you know who's holding silver. The next 30 days are going to be wild, and I'll be here breaking down every move. Thursday's data, May delivery numbers, China import figures, Iran developments, all of it.